The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bit of a sideways trades in U.S. equities, but a more directional trade in U.S. Treasuries. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. And if the S&P 500 does hold on to its gains, this will mark the first gain of the week. Just hanging on there to a 0.2% advance. It's being led by the Magnificent Seven, rebounding on the back of Tesla's earnings beat, and is now headed for its biggest rally in about 1 month. You look at the 10-year yield coming down to 4.19%, so below 4.20% as the bond sell-off takes a pause, yields getting some relief across the curve. And I included palladium surging here, up almost 9% after the U.S. asked G7 countries to consider imposing sanctions on Russian exports of the metal.
All right, let's go back to what we're seeing in the Treasury space here, because we talk about that sell-off that we had seen in stocks abating, that 3-day sell-off, but you're also seeing that sell-off abating in bonds. This is, of course, after that slump in prices pushed 10-year yields up more than 15 basis points Monday through Wednesday. On this Thursday, you get the stabilization. And the question is why? Is it a product of a market that had been exaggerated by outsized positioning, technical factors, or that lack of fundamental data? Or are yields really starting to reflect some of those bets on the outcome of the November 5th election here in the United States? Now, there's no way to be certain, but Bloomberg Economics, they took a stab at trying to get to the bottom of it, finding that better than expected economic news and the change in Fed expectations, that actually accounted for most of the 50 basis point climb in 10-year yield since the Fed's September meeting. So you get a bit of a whiplash that we're seeing in the bond market as of late, and that is also showing up to a certain extent in equities. Though we should point out that the whiplash there is driven much less by the Fed and much more by positive economic news and positive earnings surprises. And we got a big surprise last night out of Tesla. Scarlett just referenced that massive 20% rally for the stock on a strong quarter, an even stronger forecast. Well, and that maybe is providing a bit of a boost to the broader tech sector today.
Yeah, a rebound, if nothing else. But let's go back to the price action in Treasuries, because even though the sell-off is on pause today, the question now, as you pose, is what is really behind the sharp moves? And one explanation that's been making the rounds is the election, right? Since mid-September, we have seen yields, which is the white line here, rise along with the odds of a Republican sweep of the elections, which is appropriately enough the red line. Now, the thinking is if the GOP takes over both houses of Congress and the executive branch, that could mean deficit-funded growth and tariffs fueling inflation. According to Ira Jersey of Bloomberg Intelligence, single-party control of the federal government has generally led to higher deficits, and for Republicans, the culprit is tax cuts. But of course, is this correlation? Is it causation? Or is it perhaps maybe just a coincidence?
Let's pose that question to our first guest, Ed Al-Hussainy, kicking us off to the close here on this Thursday afternoon, senior interest rate and currency analyst at Columbia Threadneedle. Can you explain the moves that we've been seeing in the Treasury space over the last few weeks here, Ed?
Yeah, a little bit of all of the above. I think the culprits you named are probably exactly right? The data is surprised to the upside relative to what the Fed had going into the September FOMC. The fact that the Fed led with a 50 basis point move means that they've put a floor under the probability of a recession next year. And, the election on the margin perhaps has had, some impact in terms of positioning. I don't put a lot of weight on the election, particularly if you look at the last couple of weeks. The election's been a coin toss, and those probabilities, in my mind, haven't really meaningfully moved.
So you're not going to be sitting on your couch on November 5th with your spreadsheets open, your notebook out, taking notes here on what's transpiring? It does not matter enough to you to do that?
I think the outcome of the elections is going to be important. Am I going to be sweating it the night of the election? I hope not. I pray that I won't be.
What will you be watching for on the night of the election, Ed? Are you going to be looking at, U.S. Treasury futures or copper or the peso?
I think if you're tracking the impact of the election as the results come in, as you're tracking that, the impact on markets, I think currency markets, particularly currency markets overnight, are going to be the most liquid and perhaps the strongest signal. I will be watching for strength in the dollar, particularly versus the euro and emerging market currencies like the Mexican peso as a first reaction, particularly if the results start to indicate that Republicans are likely to take the White House and control of Congress. The opposite, if there is a Democratic sweep.
All right. Thank you for answering that. I want to go back to Treasuries for a moment here, because even if we chalk it up to the better U.S. economy, the election seems to be having an impact in terms of volatility. You look at the MOVE index, and there's been a tick up in the U.S. Treasury volatility index in the lead up to the election. And it happened in the last round as well, right, in 2020 and in 2016. How much positioning do you think there is going on in terms of just people trying to trade off the volatility, the expected volatility that we tend to get before an election?
Yeah, a little bit. You see volatility, particularly near-term volatility, being bid up across the board, across asset classes. That's consistent with people trying to square up positions going into the election. If you take a step back, volatility in rates is also up because the Fed and the combination of data that we've had over the course of the past couple of months have injected some uncertainty in terms of where the Fed is going to land. What the Fed's terminal rate is, if you will, at some point next summer. Is it 3.5%, 4%? That range has broadened out as data has come in. And so the volatility is in some ways reflecting that. I'll also point out that in my mind, the pricing of volatility has consistently overshot what volatility we've realized in the rates market. And so in my mind, it's likely that volatility is a little bit on the rich side at the moment.
Give us a sense here, Ed, when we start to talk about the idea of repositioning largely around the expectations of what the Fed is going to do, and now the presumption here that we are at least going to be in relatively stable economic conditions. And yet, Ed, we have not seen a full-on embrace of longer duration in a way that I think people thought we would have. Is this sort of a trade that's delayed, or is there a reason why people are a little bit too reticent to do that?
It's a combination of a couple of things. One, the starting level of yields across the fixed income space is very attractive. And I think that's a significant differentiator in terms of this cycle versus, let's say, the 2018, 2019 cycle. So if people have stayed in the front part of the curve, of the Treasury curve, for much longer, it makes sense. The Treasury curve just recently flipped from being inverted to being positively sloping. So the yield advantage of going out onto the further portion of the curve, let's say the 10-year yield, 30-year yield portion of the curve, that yield advantage has been relatively modest. And so the case for long duration was really built on data weakening, particularly in the labor market. That's taken a back seat in the course of the past 2 to 3 weeks. But that case isn't closed. The fact that we have a stable labor market, and perhaps a labor market that's even improving, I don't think that's been proved by the data, at least not yet.
All right, Ed, we have to leave it there. Always a wonderful conversation. Ed Al-Hussainy, senior interest rate and currency analyst over at Columbia Threadneedle, kicking us off to the close here on this Thursday afternoon. A lot more coming up right after the break, right here on Bloomberg.
One of the major topics of conversation at the IMF and World Bank meetings is the state of the banking environment, specifically for European lenders. Joining us now for more on this is Anna Botin, Santander Executive Chairman and IIF Chair. She is the first woman to chair the IIF board in its history, and she is joined by Bloomberg's Lisa Bromwitz, who is with her in Washington. Lisa.
Scarlett, great to see you. Thank you so much. And yes, she is the chair of the Institute of International Finance. Anna Botin, also the chair of Santander. And when we talk about all of the different discussions that people are having here, obviously it's the election, obviously it's what's going on with the global economy. But how much is it the divergence between the situation right now in Europe versus the situation in the United States?
Well, it's been a very busy day, but I'd say that the topics are not very different from what they were a year ago. So we're still talking about how do we get growth to accelerate. And yes, Europe is growing less, but actually on a relative basis, Europe should do better next year than this year. In the U.S., we're seeing a slowdown. So it's about world growth. How do we get growth going again in an economy that we're very happy that it's still growing and it's a soft landing, it seems, but we need to get growth to be faster.
How much are people talking about the necessity of scale of size, of scope, at a time when we're talking about UniCredit possibly taking over Commerce Bank, when we're talking about the fact that the behemoths in the U.S. are getting bigger. Is that something that's expected to continue?
No, absolutely. And, Santander is one of the biggest banks in the world by number of customers, which is what matters. We have 168 million customers across Europe and the Americas. So we have the scale. We have the global scale. We have the in-market scale. And that is a unique combination. That's what matters. We have investments in technology that are in the billions. We are rolling out global platforms. We said today that we'll have a fully digital bank by the end of 25 in the United States. We launched it a few weeks ago. So, yes, scale matters.
Scale matters, but I'm curious, because Santander hasn't made a big acquisition in years, what you're thinking about in terms of large-scale M&A in the current environment in the near term.
We haven't made a major acquisition because we don't need it. We are growing profitably. As of June, we were growing our top line at 10%. We have grown 60 million customers in the last 10 years. But very important, we're growing profitably. And we're rolling out our global platforms now in retail and consumer with our own tech stack. And so we're able to compete, with our current size. And we're going to continue to invest in technology and in people and different skills and making sure we are there where our customers want us to be. We just launched in Germany with Apple and Amazon, our digital merchant, Xenia. So we feel we have what it takes to be competitive in today's world.
And in the U.S., Santander is pushing really hard to grow through its corporate and investment banking unit, as well as the launch of Open Bank. I'm curious to hear what you think your competitive advantage is as you look to compete against the existent big investment banks and retail giants here in the U.S.
We're mostly retail, commercial, consumer bank. So we are at scale auto lender in the United States. We're number 5 here nationwide. We're the number 1 auto lender in Europe and LATAM. So we have the scale. We've proven that for many years. We have a retail bank that we have said a year ago we're going to make digital through the global platform, and that's what we've done a few weeks ago. So we are bringing our global scale to benefit our regional banks so we can accelerate deposit taking in the United States. And this is really unique.
Santander has a reputation of providing consumer loans, like you say. Mm-hmm. And right now, there's such a big question about what the consumer health really is, how able people are going to be to pay things back at a time where a lot of policymakers are saying we're reaching it. This is the soft landing nirvana. And a lot of consumers are saying we just don't feel it. How do you see the performance of these loans? Are you seeing signs of the sentiment that's more negative seeping into those loan performances?
So we're not seeing an increase in non-performing loans beyond the seasonal, trends. There's always seasonal trends in the consumer. And so, if you asked me this question a year ago, beginning of this year, we're actually better than we thought it would be. So nothing out of the ordinary, absolutely in line with what we expected, even marginally better than we expected.
So if there's nothing really wrong with consumer credit, the economy is not going wild, but it's not terrible. Is it really just the concern about the election in the U.S. that's kind of holding people back from being overly ebullient or coming up with big plans?
So, yes, inflation is hitting a lot of the consumers across the United States, has been hitting. It's cumulative, right? So it's been going on. Even though it's coming down, it's better. But yes, we feel that both and talking about the U.S. now, so we feel there is pent-up consumer demand. So we think there will be a pickup, for example, in car purchases. We get the feeling consumers are holding back a bit, and businesses too. I believe that you could see a pickup in investment after the election.
Anna, I want to ask you about private credit as well, because a lot of banks are partnering with investment firms to set up private credit partnerships. I'm thinking about Citigroup and Apollo, for instance. What is Santander's thinking about these kinds of tie-ups and the opportunities that they may present? Are you doing anything similar or thinking about it?
No, absolutely. We've been a leader in the originate to distribute model because banks are no longer the best holders of many of these loans because we have increased capital requirements. We have the distribution, as I said, 168 million customers, 4 million corporates across the world. So we are originating a lot of loans that we are then placing with the private equities. We work with all the major firms, and we believe that is something which is, good for our shareholders, and we believe, this is something we'll continue.
Anna, before we let you go, I do want to say, looking forward, what do you think is going to be the most important development in this next year for the banking sector? We talk about regulation. People don't want to talk about regulation. They're like, that's boring. But we talk about the geopolitical sphere and that could be something? Or is it the path of interest rates and just how much they actually can go down in the divergence between the U.S. and Europe?
So the big question is, the structural trends that are inflationary, right? So if you think about demographics, you think about defense spending, you think about climate transition, those are all inflationary trends. So the big question is, what is the terminal or neutral interest rate that is going to, let's say, be more consistent going forward? Probably the U.S. has a higher one than in Europe. 4% versus 3%. The question is, can the economy continue to grow with that level of rates? And the answer, it seems, yes. What we've seen in the last couple of years with relatively high rates, companies have continued to invest and the economies have continued to grow, maybe not as much as we'd like. So, for a bank like ours, interest rates in Europe of 2.5%, high employment levels. That's why, our non-performing loans are doing well. We're growing. We have a very large amount of very small accounts. And so as long as interest rates are 2.5, we're going to do pretty well on our margins, and we're going to do pretty well on provisions. So it's not a bad place for banks.
Ana Botin, thank you so much for being with us. Ana Botin of Banco Santander. And I'll send it back to you, Scarlett.
All right. Thank you so much, Bloomberg's Elisa Abramowitz and, of course, Ana Botin. Coming up, UPS delivering excellent results for investors with its latest report. What the first profit growth in almost 2 years means for the future of this delivery giant. This is The Close on Bloomberg.
All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with TKO. Benchmark downgrading to hold and removing its price target. This after the owner of the UFC and WWE said it was going to spend $3 billion in stock to acquire the Professional Bull Riders League, hospitality company On Location, and event producer IMG from Endeavor Group. Benchmark says that's a misstep, saying it will likely stunt growth and shrink adjusted EBITDA margins, hence the downgrade today and hence the downdraft in the stock 7% lower on the day. Next up, let's take a look at SiriusXM. Bank of America resuming coverage of the shares and resuming it with an underperform rating and a $23 price target. The analysts seeing static ahead with headwinds such as muted subscriber growth, elevated satellite and non-satellite CapEx, as well as higher interest costs, all which will weigh on free cash flow. The shares down about 1% here on the day. And finally, let's take a look at Honeywell. Bank of America analyst Andrew Obin downgrading to neutral after the aerospace company's earnings report, which highlighted a lower revenue outlook following weaker than expected 3Q sales. Uncertainty about the timing of short cycle recovery, while long cycle performance lacks consistency. Those are the analyst's words, and that's another reason why he trimmed the price target down to 230 from 250. The shares trimming down by about 5% here in the cash session to 209 and change. Those are some of our top calls here on The Big Show. We continue our coverage here of the sell side and a closer focus on UPS. The shares rising after the delivery giant reported its first profit growth in almost 2 years. John Chappell joining us right now, research analyst over at Evercore ISI. And John, we came into this earnings report with the expectation of lower volumes, the expectations that the customer base was going to be shifted to less profitable packages, and the expectations that labor costs will still be high. We saw an earnings report that was steady labor costs, that was actually a better improvement in the mix of what people were willing to spend on, and more importantly, an increase in volumes. Why did we get it wrong?
Well, it's not so much that we got it wrong. So let's break those down, and let's first of all give UPS credit where credit's due. This beat was a cost-driven beat. They had several straight quarters of misses and lowers, a lot of headwinds thrown at them from the economy. Obviously, the Teamsters contract, what that did to labor costs from August of last year through July of this year, and the 1.5 million packages they lost. Associated with the disruption from that contract negotiation. So a lot of punches thrown their way. They came out the other side. They've identified a lot of cost removal potential opportunities, and they did it. And they did it in a very aggressive manner. So cost per piece in U.S. domestic supposed to be down about 1.5% year over year. It was down 4%.
So then how much confidence do you have in the guidance that they gave? Do you think that they can hit those targets?
Well, the guidance is really only for one more quarter. So yes, we do think they're going to get there. But again, there's a mix here. So yes, volume was a little bit better in U.S. domestic. It was up 6.5%. It's not going to be up 6.5% in the fourth quarter. I think it's important to really take a step back and say this is a UPS beat. This is initiatives that they put into place and they executed on it in this quarter. To say that volumes were much better, I think, is a little bit misleading because you're going to make a macro read-through on that isn't quite right. They went out of their way on their conference call and in their follow-up call, at least with me, to note that you have a very condensed peak season coming up. More consumers are going to go to the store probably than shipping goods. So, there's sentiment among their shippers a little bit softer into this peak season. Manufacturing a little bit softer. I wouldn't take this beat to make it a positive read-through on the macro. This is UPS doing well despite a more difficult macro.
That's an important distinction. So going forward, did you hear anything from them in your conversations with them that gives you confidence that they can identify growth drivers that are sustainable?
Well, the growth drivers are, I don't want to call them, they're not the biggest needle movers in the world. I mean, they're going to need some help from the broader economy. But yes, they're expanding into healthcare. They're expanding into Europe. These are higher margin businesses. They're pushing price through. So implemented some surcharges. Second quarter, they took a huge mix headwind from some of these, low cost exporters in China, and they've implemented multiple surcharges since that time to help with the yields. So volume still the pressure, pricing getting better, costs getting much better. And to that question about the confidence, yes, I have confidence in the next quarter. I think the big question is how does that then translate into 2025, especially if the volume side doesn't start to reaccelerate?
What are your thoughts in terms of Amazon being a threat down the road when they build out their own delivery network?
It's a great question because it's a question we get all the time. You showed the stock price chart. The stock was up 10% on the open today. It's only up about 5% now. This is a space, UPS and their peer, that have a real tough time getting long-only sponsorship because of that Amazon threat. I think it's real. Amazon paused that for 3 years. Yeah. Now they've started to build out their infrastructure again. We know that they're going to focus on their own packages, but there is going to be a lot of spare capacity, especially 9 months out of the year, especially on backhaul, where Amazon is now starting to market to small and mid-sized businesses, trying to take what was a core legacy business for FedEx and UPS. I think that risk alone is difficult to quantify right now. I don't think it's a 2025 risk. It's probably a 27 and beyond risk. Okay. But it's big enough to keep long onlys on the sideline for the most part.
All right. Thank you so much. Really appreciate your joining us today. Coming up, we're going to speak with Robin Vince of BNY CEO, who is in New York, or excuse me, he's in Washington for the IMF World Bank meetings.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Scarlett Fu. And we're looking at a market that really has moved higher. But, in terms of conviction, I'm not sure it's all quite there.
Yeah, it's definitely lopsided. I mean, first of all, you got to factor out Tesla, a 20% move with a market cap that high. And that basically accounts for most of the S&P's gains, if not all of it here. But it gets to this idea, too, of are we going to start to see more conviction come back into this market effectively in about 2 weeks' time, when in theory we're going to know the outcome of the U.S.
I like how you've extended the election period to an entire week where we won't know what's going to happen.
Yeah, we might need to spend it for an entire month. Who knows, based on some of the polling here. But you're seeing that sort of repositioning in the equity space, and you're certainly seeing it in a big way in the Treasury space.
Yeah, although there's debate, right? Whether it reflects, the election odds or not, or if it's just a sign of a better economy overall.
Yeah, and of course there has been a lot of talk about the election, and more importantly, a lot of talk about public policy going forward. The IMF and World Bank annual meetings are now underway in Washington, D.C., and that brings together finance ministers, central bankers, and a lot of big policymakers to that town. And of course, it also brings a lot of the big bank CEOs as well. Discussions about the global economy, fiscal policy, as well as regulation. Pleased to say that one of those big CEOs joins us right now. Robin Vince heads BNY, the oldest bank in America, and one of the biggest custodians of assets in the world. He's sitting down right now alongside our very own Lisa Abramowitz. Lisa?
Thank you so much, Romaine. Yeah, this is the confab of everyone in finance and politics and policy making. And we have someone who has the first loan made to the United States when it was written up in 1789 during the time of Alexander Hamilton. Robin Vince, thank you so much for being here. I want to start with the sort of dueling ideas here. We're talking about the election, the uncertainty. We heard from Romaine and Scarlett about maybe it's going to be a week before we know the outcome. What does this mean? Is the U.S. getting more isolated? And yet people seem very enthusiastic about the U.S. and investing in this economy. Can you explain how much you're hearing that?
Well, it's certainly been a theme here at the IMF World Bank meetings, and that's been true particularly actually from foreign clients that I've been talking to, foreign policymakers. There's frankly a lot of envy about just how well the U.S. economy has performed over the course of the past 2 or 3 years. It wasn't necessarily the expectation that we would have an economy today that has actually been performing quite well. Now, it doesn't perform as well for everybody, and that is clearly an issue that the politicians are grappling with. But for those participants in the stock market, it's been a boom. For companies that have been investing in the U.S., they've been able to benefit from the various strengths that the U.S. offers: energy independence, having a little bit of light industrial policy in the U.S., labor, technology. Those things have been a real benefit and a tailwind for the U.S. economy.
There's an issue here where people are talking about maybe the U.S. is going to lose its supremacy in some of these areas, especially given the amount of debt that the United States has and the fact that it will probably have to issue more and the deficit is getting a lot deeper. As someone who sees a lot of the transactions, who processes the transactions of Treasury trades and works with the Federal Reserve, how much are you seeing this?
Well, people do talk for sure about the fact, and we have to be humble about the fact that the world can change pretty quickly. And we've had enough reminders of that over the past decade, that one has to plan for the future, but one also has to prepare for the worst. And that's a good, sensible approach to leading a business. We talk to our clients all the time about that, looking around the corners. Don't assume that rates are going to move in a certain direction. They could surprise us. Having said all of that, the benefits that the U.S. has right now are considerable. And that is what we are hearing from our clients. That is what we talk to other policymakers about. Growth really matters. At the end of the day, for a nation's prosperity, being able to grow GDP, being able to include as many people as possible in that growth. But you have to have the growth in order to be able to include people. And so in Europe, they're talking about social programs. They're talking about challenges. That takes growth in order to be able to pay for it. And so a strong economy is a really valuable benefit to be able to unlock all of those other things. Now, you're right. Deficits matter a lot. And in the U.S., we're going to have to confront that. Other countries have already had to confront those challenges. But we have certain advantages in the U.S., particularly the fact that we're the reserve currency, that we have the U.S. Treasuries as the debt sort of risk-free reference rate instrument of choice. Those are, again, advantages. Can't be taken for granted, can't be complacent, but things that have been helpful to the United States.
Robin, well, just to pick up on that point, with the election less than 2 weeks away here in the U.S., are there policy proposals, policy prescriptions that you've heard from either of the candidates that you think that BNY needs to prepare for now rather than later?
Well, we're always preparing. It's our job to do that. We help our clients prepare. It's our platforms that ultimately our clients look to in order to be able to move forward. The work that we do in the Treasury market is a great example. And so to be specific for a second, both sides of the aisle have talked about wanting to be able to spend more. It is likely under both plans that deficits would raise. And so with that, need to be able to pay for it. And so making sure that we're prepared, our platforms are prepared to be able to handle more treasuries. We settled $20 trillion worth of treasuries earlier this week on our platforms. And so that's got to be able to scale. We feel comfortable we can. I think in the U.S. Treasury market in particular, one of the important things is going to be the question of where are the buyers going to be? Because there are a lot of governments looking to raise funds, the U.S. among them, but not the only one. And the private sector wants to fund as well. Remember, we've got an energy transition to invest in, data centers to pay for, infrastructure to pay for, the focus on the grid and all of the work that's going to be required for that. Those things cost money. That's financing, and we need buyers for that.
So then just circling back then to your own business and the growth particularly that we saw out of the last earnings report, I think you're now above $50 trillion in assets under custody. Assuming that continues to grow, where is that growth coming from, Robin? Or at least where is the growth that you're targeting?
Well, the growth in our company ultimately comes from our clients and readying our platforms to be able to serve them well. You mentioned we are the world's largest custodian. We're also the world's largest collateral manager and largest issuer services firm. That helps to service all of that debt that we were just talking about. We're the world's largest securities lender. We have $2 trillion worth of asset management firms. So all of those platforms and being able to help more of those platforms help more of our clients, that for us is the growth path. That's what we've been executing this year, and that so far has been able to power our growth. But we also think it'll power our future.
How much, Robin, are you looking at possible acquisitions?
Well, acquisitions always have to be on the radar screen. We actually announced an acquisition about 2 months ago to buy Archer, which is a specific provider of managed accounts, which is one of the fastest growing areas of the asset management business. We felt that our platforms could benefit from that team, their technology, to be able to speed our growth. We're very excited about that. We expect it to close this quarter, and that's an important part of the story. And so we're scanning the horizon. That's a good example of it, looking for things that will speed us on our growth journey and will help us to serve our clients even better in areas of the market that are growing and maybe where the puck's going.
Robin Vince, thank you so much for being with us. Robin Vince, the CEO of BNY Mellon. Robin, excuse me, Romaine, back to you. Romaine, Robin, you also run a bank, the Bank of Romaine.
Yeah, it's a lot of R's. Yeah, my bank's a lot smaller than his. Our thanks there to both Robin over at BNY as well as Lisa Abramowitz. We're going to check back in with Lisa a little bit later in the program as those IMF meetings and the big voices continue to come out of that. But before we get there, we do want to talk a little bit more about Boeing getting another bruising after union members spurning, I should say, the latest labor offer. It's our stock of the hour, and it's up next. This is The Close on Bloomberg.
Boeing shares are falling again after striking factory workers rejected the plane maker's latest contract offer. Boeing and the union are now back at the negotiating table, haggling over legacy pensions. Joining us now is George Ferguson, senior aerospace analyst for Bloomberg Intelligence. George, 2 votes taken to members and 2 rejections. Can you remind us again how much Boeing is losing and how this latest rejection shines perhaps a harsher light on the outcome and the forecast that the company was able to give in its earnings report yesterday?
Yeah, so I think yesterday what we heard is that the third quarter could be a similar cash burn as they saw. Sorry, the fourth quarter could be a similar cash burn as they saw in the second quarter, which free cash flow level was over $4 billion. I think more concerning was that Boeing management even talked about 2025 being largely a cash use year. They said it would be entirely a cash use year, but things would improve in the second half. My guess is that they were probably, couching on some of that. They were probably being conservative, but I think the failed contract last night, the vote that went against them, probably doesn't make that any better. And so, now I think they got to go back to the drawing board and figure out how to get the union back into plants while also making them somewhat happy and not giving away too much that they can't be competitive.
Are there any alternatives, though, to that, George? And I mean, we get to this idea that if the demands are too onerous for Boeing to agree to, and this does drag on to the point where it materially starts to affect long-term production and output here, what are the options, if any, Boeing has?
I mean, I really see it difficult for Boeing to replace these workers, right? There's 33,000 skilled workers. You just can't pull people in off the street and ask them to start riveting airplanes together. There has to be a certain level of training that goes into it. I don't even know how you start to replace 30,000. Look, I mean, I think that workers can't hold out forever. And so my guess is that Boeing has to let this go for a little bit. They have to probably go to the capital markets, raise some cash, be ready to go a little bit of a longer haul, give the union a couple of weeks to figure out, really what matters the most to them, and then try to pull them back into negotiations where maybe they give them a little more pay raise and some more kickers on the 401k to try to get this deal done. I mean, it was 67% against. They're not that far away.
Yeah, so the fundraise will happen before it can resolve this strike. That'll be interesting.
I think so.
What does this mean in terms of Kelly Ortberg and how much leverage he has or doesn't have? I mean, he's still, I guess, struggling to put his stamp on the company here as he tries to right-size it.
I think yesterday's vote showed you there's no honeymoon. They're not looking at Kelly Ortberg as a big turnaround agent and embracing him. The union is focused on the agreement they did 10 years ago. They don't think it was a great one. And they want the economics they deserve today. I think Kelly just doesn't have any pull here.
All right, George Ferguson, thank you so much of Bloomberg Intelligence, giving us the latest on Boeing. And, he points out that they are upset, the workers in the union, over the contract that was signed 10 years ago in 2008, 2009. A lot of that was when they did away with the old school pensions and turned it into, contribution only.
Yeah, absolutely. And I mean, it'll be interesting to see. I mean, we should point out there have been other unions that have negotiated on the pension thing and actually gotten concessions on that. I'm not sure they're going to do it. I think it really does boil down to this idea of replacement. If these workers are skilled enough where Boeing cannot find a replacement for them, then that means the union does have the leverage here.
Yeah.
The question, though, is that if this does drag on, can those union members find jobs elsewhere?
That's a good point. And it's going to, at some point, they have to make a decision there. All right, coming up, we take you to the bells with Saira Malik, head of equities and fixed income and CIO at Nuveen. This is The Close on Bloomberg.
The data is surprised to the upside relative to what the Fed had going into the September FOMC. The fact that the Fed led with a 50 basis point move means that they put a floor under the probability of a recession next year. And the election on the margin perhaps has had some impact in terms of positioning.
Ed Al-Hussainy kicking us off to the close just about 15 minutes ago, 10 minutes until the bells here, and stocks, at least for the moment here, touching session highs, though the gains are relatively modest, to be sure.
Yeah, I mean, it's all on the back of Tesla. If you back out Tesla's advance, which contributes about 15 points to the S&P 500, you basically would have unchanged for the S&P.
Yeah, but we talk about that, what was it, like we had the 3 down days and everybody thought that was the end of the rally. So I think even if you get a 0.3% gain on the day, I think some people will take that at least as a sign that maybe the momentum is still in favor of the bulls. I am curious, though, about what's been going on with treasuries here, because we also had a 3-day slump in prices, which, of course, pushed yields higher. That's now reversed, at least for this Thursday.
Yeah, it's reversed at least for this Thursday, but certainly all the economic data and, there are some whispers around that perhaps the election odds are playing a role here in pushing yields higher, too.
Yeah, and I think, too, you're going to get to kind of into this move to the sidelines mentality. Of course, the Fed's going into a quiet period this weekend ahead of their Fed meeting, which is a couple days after the election, and then, of course, the election itself on Tuesday, November 5th. So
you're saying event risk.
A lot of it. Event risk, right. And if you're already invested in the market, you stay there. But who's making big wagers from
no one wants
one
to get ahead
direction
of
or
that.
another at this point, unless, you're some random dude in France. All right, let's continue to keep counting us down to the closing bell. Saira Malik joining us right now. She's head of equities and fixed income and chief investment officer over at Nuveen. And Sarah, I do want to start off with event risk a bit here, because there is a big focus right now on the outcome of the election, and more importantly, whether the lead up to that is having a bit of a dampening effect right now on what we're seeing in the market.
Romain, good to see you. Well, there's 2 events on investors' minds this week, and that's third quarter earnings and the election. And when it comes to the election, investors are wondering about taxes and tariffs. The markets are starting to price in a little bit greater odds of a Republican sweep. And in that scenario, people want to know what's going to happen with tax cuts and tariffs and whether that is inflationary. I think that's part of the reason that the market you're seeing yields back up quite a bit. The second reason for yields backing up, like we've seen that, is because of the economy. We just saw claims today. Employment markets still looking reasonably strong. The consumer keeps spending. This is this world of, are we going to get an economy that doesn't land? And therefore, inflation remains kind of sticky. Rates are cut at a lower rate than people are hoping for. And the economy keeps chugging along, and that's why rates remain a little bit higher than we've seen in recent history.
Absolutely here. And it's kind of a sort of a really broad cocktail right now that I think is driving everything. Maybe once we get past the election, and for that matter, past the next Fed meeting, that might provide a little bit more, I guess, brightness, if you will, or at least more clarity for some folks as to the direction. I do want to ask you, though, specifically. I mean, as a chief investment officer, I know you've got to be paying attention to how this election is going to play out, not just at the presidential level, but of course in Congress and even at the state and local level. On Tuesday night, when you're sitting on your couch or in your office or wherever you're going to be watching the results of this election, what are the areas of the market that you're going to pay close enough attention to in their response and in their reaction?
Well, first of all, markets don't like uncertainty. And on election day, we may not even have a result. So if there's a contested election, I think that also leads to increased volatility. So I won't be surprised to see volatility pick up as we approach the election. And then we'll see what happens after election day. I think there's certain sectors that are going to be increasingly important depending on which party is in control here. Infrastructure. Are we building more in the U.S. versus relying more on the rest of the world? Energy sector, very highly impacted versus climate. Where are we going to be spending our money? Regulations on financial companies. So those are the sectors I think would have more outsized moves as we move up to the election and polls change one way or the other. And after the election, healthcare stocks, which can have a headwind for most of this year. The healthcare sector had a headwind. It was kind of defensive in the summer, so it had a bit of a rally. But that's another sector where we need to see what's going there. And we will see that right after the close with Edwards reporting, which will give us some visibility into the healthcare sector.
So a lot of sectors there that'll be caught in the crosshairs of however the polls and the results start to look like. But in terms of the asset classes that you would like to be in, regardless of the outcome and regardless of how long it takes for us to get an outcome, one area that you do like is munis. Walk us through why this is a good time to go into munis when we've been waiting for money to move off the sidelines and it has yet to really do so.
Yeah, so money moving off the sidelines, first of all, I think cash is going to go back into liquid asset classes. And munis are an area where you can get returns above what you can earn on cash, but also with lower volatility. There's tax implications and benefits for investors owning munis, which can be a positive depending even which way tax cuts or tax rates may go. States are very strong. So fundamentally, the savings rates for states very strong. That's good for munis. And the last few days with the 10-year rising has been a headwind for munis. So I think, just if we can assume that the 10-year will actually back down a little bit, I think that's positive for the municipal bond asset class, which is what we expect to happen.
What about for treasuries at large, given the swings that they've seen heading into this election? We talked about the rise in yields, whether it's tied to the economy or, this increased betting of a Trump trade. How do you see the volatility subsiding once we get more clarity?
I think it's a combination of both, but of course the election will be behind us in the near future. It's the economy now that we need to look at. And equity markets are expecting a soft landing for the economy. I think the jury's still out in that sense. And first of all, just watching the employment markets, while they remain strong, they have slowly weakened over time. And if we get into a situation that's a bit more inflationary going forward, so we have sticky inflation, which is something that we expect, and if interest rate cuts do not come to the degree that markets hope, I think that adds more strain to the economy and to the consumer. So in that sense, I do think eventually the economy does grind to a slowdown and even maybe towards a mild recession in 2025.
That gets to the whole idea, though, too. And Saira, I know you are focused a lot on real assets and infrastructure projects. And we've heard from a lot of folks on this show, a lot of guests on this show, saying that they're doing the same. If that economy does grind to a slower pace, if you will, does that affect those types of projects?
Well, those asset classes, they're unique in the sense that they can be inflation hedges. They can continue to perform well even during periods of economic slowdowns due to the necessity-based aspects of areas such as infrastructure and farmland, which are large pieces of Nuveen's portfolio that we offer to clients. So those asset classes, if you look at investors' portfolios too, traditionally investors have thought about the 60-40 portfolio of equities and fixed income. But I think if portfolios are going to evolve to more of a 50-30-20, 50% equities, 30% fixed income, 20% alternatives and real assets. And because those asset classes, the real assets ones, are less correlated with public asset classes, they offer more diversification and inflation hedges, infrastructure, farmland. They can be more resilient to inflation and infrastructure. Not only do we have the trends of building more in the U.S., but also that tends to be more economically resilient. All
right, Saira, great conversation as always. We're going to catch up with you again soon, I'm sure. Saira Malik, she's the head of equities, and fixed income, also the chief investment officer over at Nuveen, counting us down to the closing bells here on this Thursday afternoon. The S&P 500 now hitting fresh session highs here on the day, 5810 and change right now. As we move closer to these bells, a full coverage of all of the day's actions. That coverage, this starts right now.
The closing bell. Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through the closing bell, a global simulcast. It starts right now. Carol Massar in the radio booth alongside Tim Stenovic as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Carol Massar.
Hi.
Great to see you back here.
Thank you.
But I need you to look at the market and focus for a second here. What's going on?
Can't promise you anything. No, I will focus. I think what's interesting is to see the first gain on the S&P 500 this week, in a week where we've seen a different tone. We're still early in on earnings. We've got a lot coming after the closing bell. I'm thinking about next week when we get some of the big cap tech names and whether or not what that means for market direction.
Okay, speaking of those large cap, the mega cap tech companies, I guess you could say. The Mag 7 hitting a 3-month high. Thank you, Tesla, for those results yesterday, sending Mag 7 higher.
It's amazing.
Up more than 20%. I don't want to give Carol's gainers away, but up more than 20%.
Yeah, it's
not just that, though. Tesla's point contribution to the S&P 500 accounts for all of its gains. So you take Tesla out of the equation, and the S&P 500 would be flat right now. Yeah. There's a lot that's been made, Romaine, about how there's $6.5 trillion sitting in money market accounts. Maybe one reason why people aren't putting that money to work is because they see lofty valuations, and they kind of want to wait for a better entry point.
Yeah, it's kind of interesting, though, too. I mean, the move on Tesla, when we talk about the idea of valuations and the idea that you had a stock that was beaten down. And then, of course, you get this surprise report, a surprise for a lot of folks. And, of course, that's what leads to a 20% pop here. So I still feel like if people are looking for value, I mean, you can make an argument about whether Tesla's value or not. But certainly on a relative basis to Tesla's previous valuations, certainly a value stock, at least for today. I think Carol might get to that a little bit later, but we wanted to help her out with the gainers here.
Thank you.
Absolutely. We're nothing but if not helpful. The Dow Jones Industrial Average sitting this rally out, going to close down roughly about 140 points or roughly about 0.3% as BMO and BlackRock are ringing the bell at the NASDAQ and at the NYSE. The S&P 500, though, that is going to close higher, back above 5,800, a 12-point gain or 0.2%. The NASDAQ Composite up about 0.8%. And the Russell 2000 squeezing in on the action as well, up 0.2%.
Just a little bit of a gain there. Hey, guys, almost an even split here in the S&P 500. 249 names to the upside, 252 to the downside, 2 unchanged, Scarlett.
Yeah, pretty much an even split, too, when you look at the sector performances in the S&P 500. Materials are your worst performers. Newmont, the big drag there, that group down by 1.4%. Utilities and industrials each losing 0.7%. And consumer discretionary, which is really on the back of Tesla, is up 3.25%. Communication services and REITs are each up by about 0.25%.
All right, a lot of green on that map. We've talked about Tesla a lot already. Romaine giving me, I should say, an assist earlier too, in terms of why we saw this one heading higher, finishing just off its highs of the day, up 22%, biggest one-day gain since May of 2013, top in the NASDAQ 100, a top gainer in the S&P 500. We know strong earnings we got from the automaker. Auto profit margins were also strong. The forecast of as much as 30% growth in vehicle sales next year. Elon putting that out on the call with analysts. You got to keep in mind, some analysts were out there, as you said, Romaine, low expectations going into this quarter. So anything that was good news, even slightly good, and then if it's even stronger, there were a lot of excitement over what it got. The stock.
Hey, this is going to be fun, Carol Massar. Pop quiz. Remember when I used to do these on you all the time?
No.
You said Tesla was the number one gainer in the NASDAQ 100. Do you know the number one gainer in the NASDAQ Composite today?
It's not Tesla, is it?
No, it's not.
I don't know.
Is it a pharmaceutical company?
Yes, it's a pharmaceutical company.
I could cheat, but I'm not
always go there with the biggest movers in the
biggest movers. Up 600%, Carol Massar.
Who
you
is
failed
it?
today's pop quiz. Monopar. You know them.
How did I miss that one? Now I feel like my gainers are not as exciting.
All right, what do you got next?
Hey, I just want to say, though, Tesla is...
Welcome back, Carol.
I know, exactly. Tesla is still off 40% from its high back in November 2021, so a little perspective. UPS, another one, up more than 5%.
This was surprising to me, right?
Yeah. Well, and, was up 10% at its highs, finishing the day with about a gain of about half of as much, 5% higher. It returned to sales and profit growth for the first time in nearly 2 years, driven by higher volume volumes, more profitable packages, and steadying labor costs. Yeah, I mean, they really seem to deliver. What?
But then we had Jonathan Chappell, analyst over at Evercore, on earlier today. He was kind of poo-pooing it a little bit. I mean, he kind of gave Carol Tomei a pat on the back, but was kind of like, look, this is one quarter, and they got some other issues that go well beyond what just happened in 3Q.
Let's not forget, back in January, they were planning to save $1 billion in costs, and they're cutting, some 12,000 management jobs. So there's been a lot going on at that company. And then we got some earnings, a place I think that you like to eat.
Texas Roadhouse. I don't know if I'm allowed to say this, but, I used to go there actually a lot. I have one right across the street from our office. I used to go all the time. Unfortunately, they're not doing that well, at least not in the most recent quarter. EPS looks like a miss in the most recent quarter, $1.26 on an adjusted basis. Street was looking for $1.33. Revenue coming in line with estimates at about $1.3 billion. They're just going to round that up. But the company also saying that it sees commodity cost inflation below 1%, and that's a revision lower. It previously had seen 2% here, so a potential benefit, if you will, long term with regards to its own commodity costs. So the shares, you can see, down about 6%.
Yeah, taking a look at the press release right now, the company said that they, compared to the prior year, results for the 13-week comp restaurant sales increased 8.5%. At company restaurants, increased 7.2%. At franchise restaurant, average weekly sales were $149,000, of which $19,000 were go-to sales.
But it's in the full service restaurant space, which a lot of people are down. They're leaving that behind and going to the quick service restaurant, or they're moving up from fast food to quick service restaurant. So it's kind of like they're not in that sweet spot just quite yet. Let me just jump in here with Dexcom results. Third quarter revenue meeting analyst estimates $994.2 million. Analysts were looking for just a little bit below that. But you have a big drop in the after hours trading here of almost 12%. In terms of the full year revenue, remain $4 billion to $4.05 billion, pretty much in line with what analysts were looking for. They were anticipating $4.01 billion.
Well, it's interesting, too, and it's interesting to see the share reaction. And we're also keeping an eye on Edward Life Sciences. We were just talking with Saira Malik over at Nuveen, who's actually had this on her radar. She's relatively positive on it, but it'll be interesting to see whether that competing medical device company actually has the same reaction as we're seeing right now in Dexcom.
15% to the downside.
Yeah, I mean, listen, this is one that's already down 40% so far this year, so getting hammered a little bit more, certainly in the aftermarket. All right, guys, let's get to another one that is crossing in the aftermarket. We're talking about Capital One Financial. Let me walk you through the numbers. All right, third quarter net interest margin, 7.11%. That's above the estimate of 6.91%. Net revenue, $10 billion, also a beat. The estimate on the street was $9.87 billion. Third quarter total deposits, that too is coming in higher than forecast by the analyst community, $353.63 billion. The estimate on the street, $345.43 billion. Third quarter adjusted EPS, $4.51. Quite a beat. So 451 versus an estimate of 377. What do you got?
Tapestry. We're now getting this crossing the Bloomberg terminal that Tapestry deal with Capri has now been blocked by a judge. The FTC, of course, had challenged this merger. We are now learning. We don't have a lot of details other than that right now, guys. But that Tapestry deal that, of course, a lot of folks thought would not make it through the regulatory process, Scarlett, has been blocked by a judge in a win for the FTC.
And I'm just going to point out, Tapestry shares are up about 6% here in the aftermarket. So investors reacting pretty quickly.
And this is a rare win for the FTC as well, because they've blocked a lot of these M&A deals, or at least, kind of stood in the way of them. But once they got to court, it didn't actually necessarily pan out. Again, the Tapestry deal with Capri is blocked, and this was part of their effort to create a U.S. luxury giant to better compete against Kering and LVMH.
And I am curious, though, to see how, and holy cow, can we put up Capri shares, by the way, very quickly here? They're actually down 51% here, if my numbers are correct on the screen. Someone please double check me here. But right now, trading below $20 per share here in the after hours trade.
Right.
And I think that really says it all. To get to your point, Carol, the idea that you saw Tapestry shares move higher and that you're seeing this big drop off in Capri, I think you really understand where investors' heads were at as to who this merger was much more important for, Capri or Tapestry.
That's remarkable. Shares down 52% as a result of this ruling. That's pretty remarkable to see.
Right.
Go ahead, Carol.
But it speaks to, right, like what we've seen that in some ways building these, I don't want to say conglomerates, but pulling in more brands to certainly a company can be beneficial. And certainly Tapestry saw it that way, and certainly investors necessarily saw it that way.
And I am curious, and I'm just going to play devil's advocate for a second, because we kind of saw this with the whole JetBlue and Spirit Airlines deal. You have companies that are clearly going through issues, and maybe M&A is the solution to those issues. But when you have a regulatory environment that basically says we can't allow this, then what is the future of a Capri? What is the future of a Spirit Airlines if they don't have that optionality for M&A and other strategig options?
And the other thing I would say is throw in globalization, or when there is global competition, that sometimes you need to have bigger players. I'm not saying that, you need to think about the impact on consumers and competition, but you do wonder about that going forward.
Does this make them more ripe targets for activist investors or private equity?
Good point.
But I also wonder about the consumer protection here. Like, what's the argument for not allowing a deal like this? I'm interested to hear that. Like, who are they protecting? What are they protecting?
Well, I'll say Lena Khan is more than welcome to come on the show and explain that.
Yeah, I think that'd probably be pretty interesting. Capri shares sinking by 54% after Tapestry deal blocked by judge.
Speaking of fashion.
Yeah, we're getting more
Thanks
and more.
for moving him along.
Okay, let's look at Skechers. Skechers shares are higher by close to 10% in the after hours right now. The company announced third quarter results, record-breaking quarterly sales. Taking a look at the company results, third quarter earnings per share coming in above estimates at $1.26 per share, beating estimates of 93 cents. The company also said it sees fiscal year sales at $8.93 billion to $8.98 billion. Yeah. So narrowing its forecast to the higher side because it's 8.88 to 8.9.
All right, so Skechers doing well, up 10%. Deckers, which of course makes Uggs, also doing well, up at 7% in the after hours trade. I'm just going to get right to the forecast, but the company is saying for the full year, EPS will come in at $5.15 to $5.25 per share. And I'm going to wait to give you a comparison on that. I think we have some wrong numbers here. But 2Q net sales also coming in above estimates here. You see the reaction in the shares positive to the upside.
I'm thinking Tim's an Uggs guy, and maybe Romain, you're a Skechers guy.
Hoka's.
No?
Yeah, Hoka's. I know Tim.
You guys like those big sneakers?
Why not?
No,
I've never seen it.
You only live once.
No, I don't.
It's like they're like a foam weapon. They're so big.
It's Gucci loafers all the way.
Oh, Gucci.
I mean, it's a little hard on the treadmill, but I tough it out. Sacrifice for fashion.
All right, guys. Lots of stocks moving in the aftermarket. We got to run. That's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. We will see you again. Same time, same place tomorrow.
All right, stick with us. Another busy earnings day. We're going to take a deeper dive into some of those results we got out of Deckers Outdoors as well as Skechers. We'll update you as well on that Tapestry deal being blocked. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. The three-day sell-off that we saw in equities put on pause for the day. Modest gains on the S&P 500, more meaningful gains on the NASDAQ here on the day. And the three-day slump that we had seen in Treasury prices also reversing here. Seeing that reverse, and you're also seeing yields move in the opposite direction as well. 4.2 and change right now on your 10-year yield. As far as some of the big equity moves here on the day, of course, Tesla was the star of the show. That lifted big tech, and it lifted the entire auto sector. S&P 1,500 auto and auto component stocks up 17% on the day.
Yeah, some big moves there in regular trading. Also some big moves in after-hours trading after the FTC gets a win. A judge has blocked Tapestry's plan to buy Capri. You could see Capri plunging, losing half of its market value right now. That was a plan that was set to go forward. It was an $8.5 billion deal, but a judge has frozen it, saying that it would be anti-competitive. So again, a win there for the FTC. Just staying in the retail space, Skechers, the sneaker maker, up about 10% right now after boosting its full-year earnings per share forecast. And Deckers, which is the maker of Ugg boots and Hoka sneakers, also jumping right now after its second quarter sales beat analyst estimates.
All right, and you just remember, of course, it was just really about a quarter ago where we heard from the executives at Tapestry basically saying that they were confident that this deal would get done, and it would get done this year. Stacey Widlitz joining us right now, president and founder over at SW Retail Advisors. And I do want to start there with this idea as to whether there is any possibility that they're willing to continue fighting this.
Yeah, I love some good breaking news right into this. But I think if you look at Tapestry, I never understood why they were looking at buying Capri. If you think about it, you have the Coach brand that has been able to maintain its full price stance. Obviously, during COVID, everybody was charging full price, and they've maintained that. Their higher operating margins, lower discounts. Capri or Kors has not done that. So you're acquiring a brand that is becoming promotional when you're trying to maintain higher operating margins. That doesn't make any sense to me. You also have Versace, which couldn't really get off the ground during the best luxury boom we've ever experienced. And now that we're on the other side of it, is that brand really going to add anything to the mix? So I think this is the best news for Tapestry that you're going to get.
All right. Well, I'm going to flip that around on you. What does this mean for Capri?
Yeah, I mean, Michael Kors, again, has tried to maintain full price. They've gone back into the bit of let's discount to get revenues moving. So what happens here? Your operating margin is basically a race to the bottom again in order to get business going. And that's the decision process that retailers go through. Do they go for the top line by promoting, or do we just say, okay, our business is going to be down double digits and we're just going to stick to full price? They have, in some cases that we've seen in this quarter and the last quarter, they have decided to go back to promotions. So I don't think you want to have a full price brand taking on someone that's going down that slippery slope. That is not additive to me. So I think I would hope that this deal is now tabled and put aside for good.
Sorry, we're in conversation right now with Stacey Widlitz, president and founder at SW Retail Advisors. We're going to continue that conversation in a second. Some breaking news on Morgan Stanley. We've now just learned that Ted Pick will take over as chairman of Morgan Stanley at the start of the year. James Gorman, who of course had been CEO, handing the reins to Ted Pick, now going to be handing, as CEO, is going to be handing him the reins as chairman. Again, that will be effective on January 1st. Scarlett.
Yeah, this was something that was expected to happen as part of the transition from James Gorman to his successor, Ted Pick. Let me go back to you, Stacey, to talk a little bit more about this FTC win in banning or blocking the Tapestry plans to purchase Capri for $8.5 billion. Where does this leave Capri in terms of, does it start selling off brands? Does it look for, I don't know, another partner, another buyer, if that's even possible to get past regulators?
I mean, I think the issue is that once this has been such a challenging deal, and now that we know the outcome, who would come near it and say this is worth the legal challenges and all the other distractions? You forget, this is a major distraction for a company to go through, to be trying to acquire something that then they have to go through this long legal process. So if anything, I would think that it would scare away or potential suitors. And again, you have to look at the brands. You have Kors and you have Versace, which again, we're out of the luxury boom. You saw the Kering's results. You saw even LVMH, which is absolutely the best of the bunch. Things are really tough. China's coming way in, and there's no real end in sight. This is going to be a multi-year slowdown, most likely, in luxury.
Stacey, a lot of was made of the idea that there needed to be an American version of LVMH. There needed to be an American luxury conglomerate that would be better able to withstand the competition from its European peers. Where does this leave the American luxury space? Tapestry, obviously, the breakup of this potential deal is good news for Tapestry. Can it withstand an LVMH or a Kering on its own?
Well, I think there's a big difference between aspirational luxury, what you're talking about, Coach and Kors, which is the bulk of the brands, and a heritage, true European luxury brand like a Dior or an LVMH, a Gucci. So, I think you're talking about one that is susceptible to discounting and also has an outlet business, and you're talking about others that do not promote and hopefully will never go back to promoting, that have a real heritage. So I think they're very different animals.
Stacey, before we leave, I do want to just pivot a little bit here to some of the earnings that we got here in the after-hour session out of Deckers, out of Skechers. And I want to start with Skechers for a second here, because we talk about the idea of what is transpiring in the consumer space, the health of the consumer, where they have the money to spend, but more importantly, where they're willing to spend it. At least based on the quarter that we saw out of Skechers, they seem to be somewhat of a beneficiary of what's going on.
Yes, and what Skechers, if you look at what they've been doing, we know that during COVID and right after COVID, everybody was growing their revenues by pricing. Skechers is not. They're growing their volumes. So that's differentiated. They're also growing their DTC or their direct business as well as their wholesale when that channel is kind of shrinking. You think about who they're partnering with. They're expanding into basketball. You've got Martha and Snoop Dogg as your ambassadors to the brand. That's a home run. And don't forget also that the likes of Nike, a $50 billion business, is just sending share out the door to Hoka, to Skechers, to On Running. And their business is down double digits, while Skechers is up double digits, and Hoka's business that they just reported is up 35%.
All right, Stacey, really appreciate your joining us to give us your instant take on the news with Tapestry and Capri. That deal is not going forward after a judge blocked the planned acquisition. And of course, Skechers and Decker's latest results. Stacey Widlitz is president and founder at SW Retail Advisors. She mentioned Martha Stewart and Snoop Dogg as brand ambassadors for Skechers. How much legs does that have once the Olympics are over?
Well, it has legs, I have to tell you. I mean, one of my uncles, 70-something-year-old uncle, he's got like 5 different pairs of these, the Snoop Dogg ones, just in different colors, exact ones. Because he likes them because they're comfortable and they can, slip right on and, slip off. And, look, there's appeal there. And I think having, big personalities like that certainly brings people to a product that would not necessarily normally go to it.
No, absolutely. And it's something that we'll continue to watch for. In the meantime, the stock is moving in after hours trading. We want to go back to Washington for a moment here because the IMF World Bank meetings are underway right now. And our Lisa Bromwitz is sitting down with Sergio Ermotti, UBS Group CEO.
Hey, Scarlett, I have to say, moving from affordable luxury and comfortable shoes to the state of banking in the world. And really, honestly, this is a fascinating moment of change and, frankly, changing global order. Sergio Ermotti, someone who I am so excited to speak with, in part because you wrote a Financial Times article that I thought was really interesting. You talked about the importance of protecting against protectionism, how it could create a real antithetical environment for innovation, for some of the potential possibilities that you could see coming out of companies. You mentioned UniCredit possibly taking over Commerce Bank. How much does that really stymie innovation to not allow that type of deal?
Well, first of all, I have to say that the article was meant to address, while recognizing that maybe short-term protectionism may sound good, it creates a lot of collateral damages, and particularly when you go beyond goods and services, you look at how capital can move across different jurisdictions in a way that can create value and can help address many of the topics that are affecting our economies and our societies, then you start to see really the cost. So in a sense, that's the first issue. So capital is somehow affected by this protectionism moves. But when you add on regulatory potential arbitrage, and that may or may not be a consequence of protectionism or is another form of protectionism, then you easily go into the debate of how to protect your financial markets, your local players, and then the issue of allowing or not allowing mergers between banks, not only in Europe but across the globe, becomes an issue.
It's amazing. We're talking about affordable luxury handbags in the United States, but there's a similar regulatory crackdown on the tie-ups of banks as well, and we're seeing it on both sides of the Atlantic. But what is the consequence for the banking system? Is it going to be less capital? Is it going to be banks that don't perform as well? Is it going to be higher borrowing costs? What is the consequence of there not being a greater level of merging within the euro region?
Well, first of all, when you look at even in the U.S., you have a lot of overcapacity. If I remember correctly, you have around 5,000 banks. When you look at Europe, the market is very fragmented. There is scope for creating economy of scale, diversification, and the ability through diversification then to deploy more resources to clients. The cost of that, at the end of the day, the cost is paid by the economy, by clients. I think, of course, shareholders are suffering, but eventually cost of borrowing and the facility and the easiness of accessing credit is impaired. So allowing capital to freely move across jurisdictions creates less cost for the economy.
Is there a warning from the Credit Suisse saga? You've benefited from it on the other side. Your assets have increased. You delivered earnings that outperformed expectations. there is a sense that banks that seem okay are suddenly not okay in a very fast money world. Do you worry that that's the case elsewhere?
No, I don't worry, because if you look at the Credit Suisse situation, was a very idiosyncratic topic that developed over the years. The business model was not sustainable. They didn't really have a great governance, and they benefited for too long from a regulatory concession that should not have been granted, or at least not for so long. And that was a quite unique situation. If you look at what happened back in March 2023, banks, large banks, were actually safe haven, were part of the solution, in a sense, in the US, but also with UBS in Europe. So big banks were solid, and it showed that well-designed regulators can avoid the repeat of the financial crisis. But if you go too far, then you create costs, not only for shareholders, again, also for clients. When it's going to cost more to borrow, it's going to slow down investments, and so that's not the ideal situation. There's a saying, and it's not mine, so you can't blame me or credit me, but that the United States innovates and that Europe regulates, and that seems to be the way and the path of travel, and it's the reason why a lot of people expect the U.S. to grow really significantly and less so in Europe. How much do you see that bifurcation continue with investor flows? Don't worry, I'm not going to disagree on that. So, okay. It's quite clear. You saw it in the last 20 years. Numbers talks clearly, and the underlying trend seems to go still in the same direction. There is a desire in Europe to change path. You saw with the Draghi report, with a lot of very comprehensive report analyzing the state of Europe, with a lot of ideas that, unfortunately, are going to be quite difficult to implement. The reason is that you need 27 countries with quite different interests to agree on a common goal that may result in some of them losing short term for the benefits of the long-term benefit. And in this environment, it's very difficult to get voters to support any sacrifice. And so it's likely that you're going to continue to see the U.S. outperforming Europe, and particularly also maybe other parts of the world. There's a tension right now that the U.S. election could potentially cause a lot of changes depending on who wins. And there's this fear that maybe people are not going to want to invest in the U.S. bond market as much because of some potential policies, and may want even more to invest in the stock market. Do you see that with your clients in any way, shape, or form? Do you see them preparing for the potential for some really big moves? I think clients are preparing, through diversification for discontinuity in the market. But, it's fair to say that when you look at governments and central banks, it's quite clear that they are diversifying away from the dollar. And one of the clear areas where you see this happening is when you look at gold prices up this year significantly. It's a sign that there is probably much more than just private investors or institutional investors buying gold. It's probably also central banks in different countries diversifying away from the dollar. Is UBS buying more gold? Well, we have plenty of gold. So yeah, stockpiling it. I do wonder, though, whether people in general are hoping that the ECB is going to cut rates much more aggressively than in the United States and the Federal Reserve, and are hopeful that actually that could be a tailwind in a real way. That could happen, but remember that while it's fair to say that central banks did a pretty good job in achieving their goals to have a soft landing and managing high inflations without taking down inflations without creating a recession, the stickiness also in the U.S. of the inflation is still there. So inflation is still above the target rate, and particularly when you look at core inflation. So it's a little bit early to predict that central banks can really go fast in taking down rates without creating a potential collateral damage. In this environment where geopolitics can create discontinuity in supply chains, in energy supplies, it's very dangerous to go too fast and then having to basically retreat, and that at this stage it would be very bad to see rates coming back, because actions that have been taken to aggressively on the rates front.
Sergio Ermotti, thank you so much for your time. Sergio Ermotti there, the CEO of UBS Group. Back to you.
All right, our thanks there to Lisa Abramo. It's a great conversation with the UBS Group CEO, Sergio Ermotti, of course, down there out of our Washington bureau, the site, of course, where those IMF and World Bank meetings taking place just down the street from Bloomberg offices. Let's get a check on the market. Scarlett?
Yeah, in regular trading, we saw stocks rise for the first time this week. That was cash trading, of course. It was a fairly modest move, but after the market closed, we've seen some big moves, especially in the retail sector. You look at Capri Holdings, down almost by half of its market value, losing 48% at the moment after a judge has blocked Tapestry's $8.5 billion purchase of the company. Capri, of course, the company behind the Michael Kors brand, also Versace. Tapestry owns Coach and Kate Spade. We're also paying attention to footwear companies Skechers and Deckers. Both companies reported results. Skechers boosted its full-year forecast, while Deckers, which makes Uggs and Hoka's, reported a second quarter sales beat. Romain?
All right, let's take a quick look back here at this day in history. We want to go back to October 24th, 1940. That was the day, believe it or not, when the 40-hour work week became the law of the land in these great United States of America. That law, the Fair Labor Standards Act, is arguably the most consequential piece of legislation designed to protect and enshrine worker rights. And the core of that bill was the establishment of a minimum wage of 25 cents an hour, a prohibition of oppressive child labor, and a mandate to pay time and a half overtime to any worker who puts in more than 40 hours a week. FDR, in signing the bill, called it the most important part of his New Deal since the Social Security Act of 1935. And while there were plenty of exemptions to the work hour rules, the law and its numerous amendments over the years have held up. While signed in 1938 and revised and put into effect on this day in 1940, the idea of an 8-hour workday and a 40-hour work week started to unfold more than a century earlier. That was during the Industrial Revolution, when putting in 80 to 100 hours a week, that was the norm. But by the mid-1800s, activists had made enough progress on this issue to convince President Ulysses S. Grant to issue a proclamation guaranteeing 8-hour workdays for government employees. Now, that decision on government employees encouraged private sector workers to push for the same rights. Now, it was not without drama, though. Most famously, we know that state law in Illinois back in 1886 mandating 8-hour workdays led to a revolt by corporate titans, which led to a revolt by workers and ultimately violence by police, culminating in the deadly Haymarket Affair. But by the turn of the 20th century, corporations actually began to warm up to the idea of a shorter work week. And partly that was because of research popularized by Henry Ford, who showed that working longer yielded only a small temporary increase in productivity. But when you paid workers more and you improved their working conditions, that created a bigger and more permanent boost to employee output. Scarlett?
Great summary there of what's going on, especially in light of some of the labor issues that we're seeing around corporate America. In the meantime, I want to turn back to earnings and the banking sector in particular, regional banks. Valley National Bank closed the day up 5.25%, and this is after they reported a beat in the third quarter net interest income. I'm pleased to welcome Ira Robbins. He is the bank's chairman and CEO. Ira, thank you for joining us today on The Close. I know that in your earnings statement, you talk about arriving at the early stages of normalized profitability, which you see really picking up in the lead up to 2025. I'm curious to hear what your built-in assumptions here are for interest rates and for the economy overall.
I think it's, to your point, Scarlett, really two components to it. One is, what does that macro interest rate environment look like? Our expectations are right now for 25 basis point interest rate cuts as we get in through 2025. Really a more normalization of what that yield curve looks like, and really what that does from an economic perspective as we think about continued GDP growth. So for an organization like Valley, the interest rate environment would then be accretive to what we think net interest income build would ultimately be, and credit would really begin to normalize as well for us.
Now, back in April, you had said that, or the bank said it would reduce its traditional focus on commercial real estate lending over the next 2 years. And I know you've agreed to sell performing commercial real estate loans of at least $800 million to one single investor. You sold it at a discount of approximately 1%. Is this the kind of discount investors should expect for other CRE loans going forward?
I think it really depends on the credit quality and performance of those. And to your point earlier, what does that really reflect of what the environment looks like? Back in April, when we first started giving guidance of what the commercial real estate portfolio was going to look like, a sale of this same portfolio probably would have gone for about 90 cents on the dollar. So as people get much more comfortable with the asset class, have the ability to look through and say every commercial real estate loan isn't made the same. Let's look at the underlying characteristics of that. More liquidity flows into the space. Pricing obviously improves. So for us, wonderful execution, amazing demand that we had looking at this, and really, really pleased at where we ended up.
Give us a sense, though, when we talk about a continued growth, Ira, and kind of where regional banks like yours, and for that matter, just the idea of the banking sector overall, which is facing a lot of different challenges. For folks that are your size, and meaning banks that are your size here, is there an independent future for you guys?
Absolutely. I love Lisa's conversation before with the CEO of UBS talking about what the difference in U.S. banking environment looks like versus what it is in Europe. And we talked about the difference between U.S. banks innovating versus what happens in Europe, where everything gets regulated, right? The innovation that happens in the U.S. is a function of the deployment of capital. Right. And the fact that we have 5,000 banks deploying capital to entrepreneurs, that people have different ideas and concepts to how about they grow their business, is tremendous. In Europe and other geographies, you have 3 or 4 decision makers about where capital flows, right? So it's important for an organization like Valley. It's important from the U.S. financial system as we think about GDP growth, as we think about innovation and spurring new development, to have organizations like Valley. There are only 11 banks from a size perspective that are commercial focused like Valley in the entire country today. Right, so there's been definitely a contraction, more focus on what the larger end are and what the smaller end are. But to be in the middle is a wonderful space for us today. We see tremendous opportunity to grow our book and really provide value from an economic perspective as well.
Have you had conversations with regulators, and I'm talking primarily federal regulators, about a way to facilitate more than that? I mean, your anecdote about roughly 11 banks, I mean, I could tell you, in the neighborhood I grew up with, I think there were like 4 of those banks literally within walking distance of generally my stomping grounds growing up. That was just in one city and one neighborhood. And all those banks, of course, are long gone, replaced by your Chases and cities of the world. No offense to them. But my question is, when you talk about the importance of what you do and what your peers do, and I think everyone recognizes that, why aren't you getting more regulatory support to expand that vision?
I think regulators are definitely supportive of the diverse banking environment that we have today. I would say sometimes there are unintended consequences based on regulation that gets put forth. And it's well intended to begin with. I mean, we can talk about the long-term debt conversation that's been out there, right? So increase long-term debt. Well, what happens when you increase long-term debt requirements at financial organizations? The large banks like JPM and Wells are able to issue that debt at lower rates than where an organization like Valley is able to issue it, and at a much more attractive rate than what some of the smaller community banks are. So when we put forth regulation that increases capital requirements blatantly, consistently across the organization, across the banking environment, when we put forth more requirements for long-term debt, those in itself have unintended consequences of creating a too big to fail environment. I think we are having more traction in our conversations with the regulators, but those are conversations that we need to have. They're well-intended regulations. It's the unintended consequences of those regulations that are creating the environment we're in today. But I feel very strong that we have solid regulators there that have an understanding and are well-intended in what they're doing. And we'll end up definitely in a very good spot.
Going back to that idea that American banks innovate while European banks regulate, what are your conversations with clients, with customers like? Where are they? What kind of demand have you seen from them, and what's their time frame for really investing in their businesses and building out what they have started?
It's a great question. It's really interesting, right? I mean, I think you can always go back to what happens before an election. You're always going to slow down because of this uncertainty. I would argue it's probably unwarranted because no matter who gets elected, the U.S. is still going to have a strong economy, I would say, and move forward. So we are seeing people right after the election really begin to invest back in equipment and other term projects. That said, it's still been strong. Most of our borrowers are doing really, really well. There's a few segments from the industry, and you think about home building, and you think about what happens in the apartment lending spaces that are real challenged. But outside, from a general perspective, most of our C&I companies are doing really well and showing strong profits.
All right, Ira Robbins, thank you so much for joining us today. Ira Robbins is chairman and CEO of Valley National Bank, which reported a third quarter net interest income beat, and the stock finished higher in after hours trading. Should we just recap some of the companies that did report earnings? We got so caught up in the retailers. There were a bunch of other names as well. Sam being one of them, Boston Beer.
Yeah, and I mean, this was one that I'm really interested in too, because we talk about this idea of shifting trends in alcohol consumption here, and we know that in the past they've sort of fallen a little bit short here. The numbers that they had actually weren't great here, but we should point out the bar had already been lowered. We know that EPS was going to be light. We knew that revenue was also going to be relatively light, but the forecast they gave, while somewhat below what the street was looking for, was still a little bit better, I think, than what some people had coming into today.
All right, we're also keeping an eye on Universal Health Services, the hospital company. A big drop here in after hours trading by 11%. Its third quarter adjusted EPS did beat analyst estimates. We look at the net revenue, $3.96 billion, just slightly higher than what analysts were looking for. We'll continue to dig into these a little bit more, but a big move, at least for now.
Yeah, L3 Harris getting the bid as well here. Of course, we had that back of that Palantir partnership reported yesterday. Decent earnings today in Digital Realty, of course, riding the wave right now of the data center build out, up 7% here in the after hours trade. This is The Close on Bloomberg.
It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Ted Pick. The Morgan Stanley CEO has just been named chairman of the board of the firm as well. That is effective January. He basically replaces his predecessor, James Gorman, who then moves on to become chairman emeritus.
Yeah, and I mean, this shouldn't have been a total surprise here, but kind of interesting now to see that Gorman has really kind of wiped the slate clean. Of course, already handing off the baton on the CEO side, and now the chairman baton being handed off on January 1st. I'm keeping an eye on Bob Duggan. Of course, he is the very prolific investor now running Summit Biopharma Therapeutics, I should say. And he's buying one of the most expensive condos ever sold in Miami's Brickell area, a $33 million two-story penthouse. This surprised me, not because he paid $33 million. I would have figured there would have been a higher price property that would have gone there. I feel like every time you read about something going for sale down there, it's always like, 50 or 100 million or something ridiculous. But
maybe he'll flip it. I don't know. It's a 360-degree view, which is pretty incredible.
I would hope so for $33 million.
Yeah. Well, he bought the property with his life partner and co-CEO, but his backstory is so fascinating. Did you read about it?
I'm sorry, what did you say? His life partner and co-CEO?
Yeah. There's a lot going on there.
I missed that detail.
I know. There's a lot going on there. But his backstory is really interesting because he has invested in a lot of businesses, but he's not a doctor or scientist.
No.
And this is the second drug company that he's invested in where they had a cancer treatment, and it's done well.
Yeah, multi-billion-dollar net worth.
All right, third on the docket is Jonquel Jones, the 2024 MVP of the WNBA Finals, and the rest of her New York Liberty team celebrated their championship win with a ticker tape parade down Broadway in downtown Manhattan. By the way, the New York Liberty is now the fastest seller of post-finals merch on Fanatics.
I don't actually see any ticker tapes falling here. Did they shortchange these ladies for some reason?
No, I think there was ticker tape coming down.
Well, I hope
or maybe there's a greener version of that.
I'm going to keep an eye out. I feel like one of our producers is in the crowd.
She was definitely
in
the crowd.
She's like the biggest Liberty fan in the world. Super fan.
Maybe we'll get another ticker tape parade, in a couple of weeks. I don't want to, say too much.
Well, you've just jinxed it now here. Let the Liberty have their moment here. You're looking at the scenes from Lower Manhattan earlier in the day, and maybe you can celebrate by tipping a little glass of whiskey to your lips a little bit later, or maybe we can do that right now. Our next guest, her name is Fawn Weaver. She's the founder and CEO of Uncle Nearest. It's a whiskey brand that is continuing to expand in popularity, and the company is continuing to expand its portfolio, recently announcing a new whiskey that was created as a more approachable and inclusive option, both in proof, point, and price. Fawn joins us right now, live here on the set. Great to have you here.
Thank you for having me.
We've had you on before kind of talking about the origin of Uncle Nearest and where it came. And we knew there was going to be an evolution, particularly with your background in finance. We're now seeing that right now. First, just talk about why you felt it was necessary to create something at a different price point. Because I know Uncle Nearest is pricey, but it's not like out of the reach for most folks.
Well, what you're seeing, especially with the big guys that you all track, the LVMHs, the Diageos of the world, they've all begun to price everything down. But what they're doing is they're taking their core products and they're bringing those prices down. The problem is when you do that with consumers begin to expect that. You can't bring those prices back up. And so now they're going to have to deal with these lower prices for many years to come. For me, I said, no, we're holding pricing integrity for Uncle Nearest. It's worth every penny. But Nearest Green Distillery it was never named Uncle Nearest Distillery. People didn't ask why, and we didn't share it. And it's because we always knew this bottle would come. This $30, $29.99, that would be the bottle that would go around the world. The Nearest Green Tennessee Whiskey, because that's a price point that doesn't just work in the U.S. It works in Europe, it works in China, it works everywhere.
Well, I am curious on that, too. I wish to point out the first Uncle Nearest, at least the ones that are in New York, if you go into a store, you're going to pay maybe $70 or so, roughly, for that. So it's a significant price difference. I do wonder, though, given that you're sharing, it's the same company, and to a certain extent, people are going to associate it with Uncle Nearest. Do you worry that when people drink the cheaper version, and I don't want to say lower quality, but I assume it's going to be a slightly different.
It's phenomenal.
I'm not saying, I'll be careful.
Yeah.
But I'm just saying that if they have an assumption of what they got with that $70 bottle and they buy the 30, do you worry here that people will conflate the two?
Not at all, because Uncle Nearest is Uncle Nearest. Nearest Green Tennessee Whiskey is Nearest Green Tennessee Whiskey. So it's almost like if you were conflating Buffalo Trace and E.H. Taylor or Blanton's. No one will conflate those two because they're two very different products. Mostly the proof levels are what is so different. And so a person who's drinking 100 proof is more likely not to mix that in a cocktail. What this allows us to do is to go into the wells. And so our Nearest Green versus everybody, we're literally taking a marketing thing that Jack Daniel did back in literally in the 19th century. That's how he got people to try Nearest Green's whiskey the first time around, is he would walk into a bar with a silver dollar and he would challenge the consumers, try whatever you normally drink against my whiskey from Lynchburg, Tennessee. And what he had in those bottles was Nearest Green's whiskey. So we called the U.S. Treasury and said, how many silver dollars y'all got up there? And we bought an insane amount of silver dollars, and we're now going around the country doing the same thing. So it's Nearest Green versus everybody part 2. And we're going and putting down silver dollars and saying, whatever is in your well for your restaurant, your bar, we'll challenge you blind taste test.
Fawn, I think you just revealed your superpower, which is your ability to tell stories about your product. And storytelling and brand building is critical in this industry, especially for independent players like yourself. You know, I mean, the big conglomerates can have their story told and they have a lot of slick marketing. What is the single most critical advantage that a small independent brand like yourself holds over the multinational conglomerates when it comes to that storytelling?
Heart, authenticity. I don't have a single marketing and advertising firm working for me. If you see it, if we put it out, it came from my brain. It came from my heart. And so that's the difference, where they will have all of these campaigns that they'll put together. They'll spend tens of millions, hundreds of millions of dollars. It'll go out to the public and it won't hit anything. And that's because they did it, they incubated it, they sent it out to a group of people, but there's no heart connected to it. And this consumer, Gen Z, what we call Gen Zennials, that in between millennials and Gen Z, they are requiring authenticity. And so the big guys are going to have to figure out how to do that. And right now, they don't really know how.
Well, some of the big guys partner up with celebrities, right? Athletes or actors who launch their own brands. And they will say that they bring a lot of heart to their brands. And their advantage, of course, is they have a built-in fan base that they can market to directly. How do you compete against that kind of marketing edge?
I don't. So I'll take, without saying any names, one particular person who has a spirit brand, right? But every single time we see him on social media, every time, he's drinking red wine. So the consumer is not going to go and buy your spirit brand if they know that what you really love is red wine. So the few celebrities that have done well in this business, and when I say few, it's like less than a handful, those are the ones who actually drink the product. But most of them, they just take the check. They'll do a couple promos, they'll post a few pictures, but it will not do well over time. It's the reason why I've never used a celebrity for Uncle Nearest.
You are expanding the company to other product lines, not just whiskey itself. Talk a little bit about whether that approach is going to be different than the one that you took with, first of all, reviving the legacy of Uncle Nearest to start with, and then, of course, expanding that out to the other whiskey brands.
It is and it isn't. And by it isn't is every single one is story-driven. If I was teaching at Harvard yesterday, and I was sharing about storytelling, and I said, listen, if you're trying to build a business and it doesn't make the hairs on someone's arm stand up when you talk about it, go back to the drawing board, find out something else. Because if it doesn't excite you, it's not going to excite the consumer. consumer in this day and age. There's too much media coming at us nonstop. And so for me, when I tell the story of our cognac, the hair on my arms, and I'm the one telling the story, the hair on my own arm stands up. And that, I think, is what you're going to find coming out of Uncle Nearest Inc., the umbrella company. Every single brand and company in our portfolio will make you excited because of the backstory. And then the quality doubles down on an excellent backstory.
Part of your story as well is that you have shunned VC and PE funding in favor of lots of small investments from individuals in order to maintain control of your company. Is this an outright ban? I mean, an unequivocal no, hard no, or, is there room, you think, down the road for some kind of partnership with institutional capital?
I never say never for anything, but I don't see it. And the reason I don't see it is I've got plenty VC CEOs and owners in my company, but as individuals, because it's not just about maintaining control. There is a difference between a VC founder and CEO being on my cap table and working with me personally versus Uncle Nearest being on a piece of paper in which some junior analyst is the one. And that's what happens in the VCs. You have a junior analyst that's then analyzing it without knowing me. And so for all of the VC heads that are in my company as individuals, they act as advisors to me. And so I have the best of both worlds where I still have them. They help me to build the brand, but I don't have a junior analyst that isn't connected heart to heart.
All right. Well said, Fawn, and always a great conversation. And we got to get you back on soon to talk about the progress here of the expansion of that Uncle Nearest umbrella. Fawn Weaver is the founder and CEO of the Uncle Nearest brand. When we come back here, we're going to push ahead to some of the potential market moving events over the next 24 hours. This is The Close on Bloomberg. All right, let's push ahead to the potential market moving events over the next 24 hours, and that includes some earnings tomorrow.
Yeah, we have Mercedes out of Europe, and we have Colgate-Palmolive here at home, and no earnings after the close because it is a Friday.
Yeah, it is a Friday here. Earnings season, of course, are really going to kick into high gear next week. But before we get there, we do get some economic data tomorrow, including durable goods at 8:30 a.m.
Yeah, I wonder if this is going to show any kind of the disruption tied to the port strike that only ended up lasting 3 days.
Yeah, it'll be interesting to see what that means. It'll also be interesting to see how consumer sentiment is holding up with those UMISH numbers at 10 a.m.
As we get closer to the election, I'm sure some of that will be reflected.
Yeah, absolutely. And maybe a change, if you will, depending on how things shake out. And I know you love it, Scarlet Fu, but just wait for it. The Fed goes into a quiet period this weekend. But before we get there, we get more Fed speak, including from illustrious Susan Collins there.
Susan Collins at 11 a.m. And of course, it'll add to the debate of what the Fed does next.
Will it add to the debate?
Oh, yes, it certainly will. And we'll continue debating it forever.
Or detract from the debate. One or the other. We'll be here to cover it all for you tomorrow. In the meantime, all your politics coverage coming up next on Balance of Power, right here on Bloomberg.